Hi, welcome. You know what they say about taxes, right? Death and taxes, the two things you cannot avoid in life. And taxes are probably more boring to talk about than debts, but I'm going to try today. And in particular, I want to talk about corporate taxes. You're saying, why now? The reason pretty straightforward. A couple of weeks ago, the Biden administration announced a $2 trillion infrastructure plan, funded primarily with a raise in corporate taxes. Now, half the debate is about what comprises infrastructure, and I'm not entering that debate. But the other half is whether corporate tax rate should be raised from 21 to 28%, and whether that'll provide sufficient revenue to cover the $2 trillion cost on the infrastructure plan. Now, for those of you who have a history, who remember the history of US tax rates, the 21% tax rate is relatively recent to the US because until 2017, that tax rate was 35%, at least at the federal level. It's now dropped to 21%. Now, when we think about debating taxes, one thing needs to be kept in mind. No debate about taxes is ever honest because we all have our biases and preconceptions about whether companies pay enough in tax or whether they need to pay too much. And it's amazing how we self-select the data to back up our positions. I'm going to try as best as I can to try to tread the middle ground here. If you ask me what the effect of changing tax rates on value is, my answer is it's complicated. You're saying, what does that even mean? Now, normally when I ask you if I had to raise the tax rate on companies, what will happen to the value? The answer seems pretty obvious, right? When tax rates go up, there's less after-tax income and cash flows, value should go down. True, but there are three caveats. The first is when tax rates are increased, there's a feedback effect on taxable income and deferred taxes. What do I mean by that? This might be just the cynic in me, but when tax rates go up, companies find ways to report less in taxable income and defer more taxes into future years. They're not necessarily even breaking the rules, they're just using the discretion in the tax code. The second is almost no change in the tax code is just a change in the rates. Other things come along with it, sometimes cutting against the change in the tax rates and sometimes helping. For instance, the 2017 Tax Reform Act lowered the corporate tax rate from 35% to 21%, but it also put limits on how much you could deduct interest expenses. And thirdly, when you change tax rates, you affect the relative costs of debt and equity. And here's why. Interest expenses are tax deductible in much of the world. So when tax rates go up, the cost of borrowing money actually decreases relative to equity. You've made debt a more attractive way of financing. So you look at the effects that tax rates play on value, the effects are in a multitude of places. First, when the tax rate changes, that's a tax rate in the tax code, that's called the marginal tax rate. The tax rate in your last dollar of income, it affects your after-tax cost of borrowing, how much debt you use, and through that, your cost of capital. When the tax rate changes, how much you pay in taxes on your overall income. Let's call that the effective tax rate, the actual taxes paid as a percent of income, can also change, and through that it affects your after-tax earnings and cash flows. So if you look at what kinds of companies are most and least affected by tax rate changes, it depends on two things. One is how many options does a company have to defer taxes. The more options a company has to defer taxes, the less it will be affected by higher corporate taxes. You're saying, what can drive that with those options? I'll give you one example. Companies with more foreign income, US companies with more foreign income, have more choices when it comes to deferring taxes than US companies that get all their income in the US. Here's another. Companies that sell intangible products and services, Apple selling iTunes, for instance, have a more leeway than companies that sell tangible goods and services. We can see where the item is sold. The second factor that drives how much tax rates affect value is how much debt the company uses. Companies that are heavier users of debt will be able to offset at least some of the tax rate increase by having lower costs of borrowing. Put simply, when tax rates go up, the effects on value can vary widely across companies. Some companies will be less affected than others, and a few companies might actually emerge as winners. So let's look at the history of US tax rates to see where we are today and how we got there. This graph looks at marginal tax rates, corporate tax rates in the US going back more than a century. You can see the surge in corporate tax rates around the Second World War, partly to pay for the war. They stayed high for a while. And then they dropped in 1986 to about 35%, and that's where they've stayed since. until 2017. 2017, that tax rate was dropped from 35 to 21%. For those people who are the strongest advocates of raising corporate tax rates, this graph is their backing. They say, look, US companies are paying less in taxes than they've historically. What's the harm in raising the tax rate? Well, remember, much of this tax code was written when the US was a dominant force in the global economy. It was the global economy. And it was written at a time where other countries also had corporate tax rates very similar to the US. Here's what's changed. The rest of the world has moved on. The US is now still the largest economy globally, but it doesn't dominate the way it used to in the middle of the last century. Second, the corporate tax rates in the rest of the world have come down. Along the way, there's something worth noting. For much of the last century, US companies were required to pay the US tax rate not just on US income, but also on income made overseas. So for instance, US company who made income in a country with a 20% tax rate, the US tax rate was 35% as it was before 2017, you had to pay the extra 15%, but only when you repatriated that income. You can already see the consequences. In fact, by 2014, I wrote a post where I described the US tax code as the most dysfunctional tax code in the world, because here's what it had. High marginal tax rates, which induce companies to borrow more money. But the effective tax rate was very similar to the rest of the world, which came from the fact that US companies with foreign income often kept their income overseas. That income is called trapped cash. Trapped because while it could not make it back to the US, it couldn't be paid as dividends, used to buy back stock, invest in the US, it was trapped, trillions of dollars. So when the US lowered tax rates in 2017 from 35 to 21%, it actually was bringing itself closer to the rest of the world rather than further away. Something to keep in mind as we talk about raising that tax rate again. In fact, if you look at the marginal tax rates across the world, and this graph kind of captures that, and I've broken down by regions, you can see the marginal tax rate in the US first is not 21% because that doesn't include state and local taxes. According to KPMG, the marginal tax rate in the US is closer to 27%. That might be a little bit of an overshoot. I think it's closer to 25%. But even if you use 25%, you compare the US marginal tax rate to tax rates around the rest of the world, you can see very quickly that it's much closer to where the rest of the world is now than it was in 2015, 16, and 17, when it clearly was an outlier. So that's marginal tax rates. But remember, companies don't pay marginal tax rates. Their taxes are based on a bunch of other factors. In fact, what companies pay in taxes is usually captured with an effective tax rate. You're saying, what's an effective tax rate? It usually comes from the income statement. You take the taxes paid in an income statement, you divide by taxable income, you have an effective tax rate. Now, is that a good measure of taxes? Well, there are lots of other clues in the financial statements that you can use to get a sense of how much your company is paying in taxes and what its tax behavior looks like. So let's go on a very quick visit through the financial statement to see which ones contain what information. Let's start with the income statement. Just look at the income statement for any US company or any company globally. There'll usually be a taxable income line item and a tax line item. You divide taxes by taxable income, you have the effective tax rate. Remember though, the income statements are accrual statements. In other words, these are not based on cash revenues, cash income, and cash taxes. These are accrual income-based income and taxes. To get a sense of how much your company actually pays in taxes, you can go to the statement of cash flows. So if your company has an effective tax rate of 21%, but it chooses to defer taxes, you will see that show up as a positive cash flow under the statement of cash flows because they're deferring taxes. In fact, if they keep deferring taxes, those deferred taxes will build up in the balance sheet as a deferred tax liability. So the income statement gives you an effective tax rate. The statement of cash flows will tell you how much your company actually pays in cash taxes through the deferred tax line item. And your balance sheet will tell you about the past behavior of your company. Companies that have consistently deferred taxes will have a deferred tax liability on the balance sheet, and companies that have consistently prepaid taxes will have a deferred tax asset. Of course, there can be items in the footnotes on what this company is carrying forward as net operating losses. Because remember, in the US, if you lose money as a company, you're allowed to carry it into future periods. So you ask me, can I trust the effective tax rate? Yes, but with caveats. First, remember, it's an accrual income and tax-based measure of the tax rate. It might not measure what your company actually pays in cash taxes. That's why we look at cash taxes versus accrual taxes. In addition, in any given year, the effective tax rate can be a strange number for two reasons again. One is you can have net operating losses and tax deferrals from previous years catching up with you, which can push your effective tax rate above 100% in a particular year, which looks strange, but it reflects past behavior, or even below 0%. But effective tax rates still are useful for individual companies, but there's a lot of noise around them in terms of estimation error. So what do we do with that? We average. And it's a challenge to figure out what a group of companies is paying as tax rates. So for instance, if I ask you, are software companies paying their fair share in taxes? The way you compute that average tax rate can make a huge difference. You think, why? Well, I can report how much a company pays in dollar taxes, or how much a group of companies pays in dollar taxes, both in accrual and cash terms. That's an absolute value. I can report the average effective tax rate across all software companies. You think that should be good, right? Well, if 2/3 of your companies are losing money, that average effective tax rate is going to be really low. Why? Because those 2/3 of companies that lose money pay nothing in taxes. They have a zero tax rate. I could report the average effective tax rate across only money-making companies. That takes care of the money-losing company problem. But if some of your companies are small and some are large, I might get a very misleading view of what that group of companies collectively is paying in taxes. So my preferred measure for how much a company pays in taxes is use what's called an aggregate tax rate. What does that mean? I add up the taxes paid by all of the companies in my group, and I divide that by the aggregated taxable income across all of the companies in the group. What does that allow me to do? It allows me to create a weighted average without even trying, right? Because the larger companies will then have a much bigger effect on my tax rate. I report all four of those tax rates by sector for groupings of companies, industries in the US, global companies on my website, and I'll give you the link. You can get it at the end of the session. So I'm going to use the effective tax rate as my measure to look at how US corporate tax behavior has changed, primarily around the 2017 change in the tax code. Remember, that change happened at the end of 2017. So the 2016 and 17 numbers here reflect the old tax code. The 2018, 19, and 2020 numbers reflect the 3 years since the tax code change. Now, 2018, the numbers are skewed because that was a year in which companies were given a one-time deal where they were allowed to bring that trapped cash, remember, foreign income that had been trapped outside, to the US and pay a higher tax rate. So when you see the jump in effective tax rate in 2018, that reflects that additional tax paid that year on the one-time deal. 2020 is a nightmare because of COVID. You have all kinds of damage created to companies. So in a sense, 2017 and 2019 are probably the years that best fit the pre and post reform behavior. So let's see what the Tax Reform Act did to tax behavior in the US. Well, let's go back. The marginal tax rate at the federal level before 2017 was 35%. It became 21% after 2017. That's a 14% drop in the corporate tax rate. It affected effective taxes. The effective tax rate paid by US companies went from 24.65 to 18.57%, a drop of about 6%. Not 14%, but 6%. Saying there, I told you US companies are paying less in taxes. Not so fast. Because the dollar amount paid in taxes by US companies actually increased in 2019 versus 2017. So how can that be? If the effective tax rate dropped by almost 6%, how come US companies are paying more in dollar taxes, both in accrual and cash terms? The answer is very simple. It's because they reported far more in taxable income and they did far less tax deferral. In other words, one benefit that came out of the 2017 tax reform is companies felt more comfortable reporting higher income and deferring taxes less. So if you look at the changes in dollar values from 2017 to 19, you can see how different groups can use these numbers to their own purposes. A group that wants to show that US companies pay less in tax is going to focus on the effective tax rate and leave it at that. Now, somebody on the other side of the debate who wants to US companies are paying more is going to use the dollar taxes paid. I think the truth is that the 2017 Tax Reform Act did affect taxes, but it didn't affect taxes in as massive a way as many people are framing it to be. In fact, to give you a sense of how little impact 2017 has had on overall taxes paid by US companies, I've graphed out the effective tax rate in this graph going back to 1929. Now, this is from a very different data source than the previous graph where I used the financial statements of companies. This comes from the US government, from the Bureau of Economic Statistics. And it looks at total corporate taxable income and total corporate taxes as defined by them. And while there can be disagreements between different data sources, the story remains the same. US companies pay less as an effective tax rate in this century than they have in the previous century. And you can't blame the 2017 tax code for what's been happening for almost 20 years. What I'm trying to argue for here is if we're going to change the tax code, let's at least start with a platform of honesty, which is let's not make it seem like US companies are paying far less in taxes now just because of the 2017 Tax Reform Act. This is something that's been a long time in the making. So if you look at 2017, it did lower the marginal tax rate. The effective tax rate dropped by less, but US companies actually paid more in taxes. Let's start with that base and let's talk about it. Again, there's nothing wrong with arguing that US companies need to pay more in taxes, but let's at least start with why that is. Why are they paying less in taxes? Because otherwise we might raise the tax rate from 21 to 28%. But we will not see the increase in taxes that you might want to see if your end game is that US companies need to pay more. Now, if you compare what US companies pay in effective tax rates now, the previous graph, I was comparing marginal tax rates, and there I said US company marginal tax rates look very similar to the rest of the world. On the effective tax rate front, there is an argument to be made that US companies pay less in taxes than companies elsewhere. In fact, Canadian and US companies are the outliers here, with tax rates less than 20%. Now, you're saying, how do we reconcile this with what we saw on the marginal tax rate page? I think it's a testimonial to the amount of deductions and credits that have been built into the US tax code over time. And that effect creates, that basically also creates these very diverse effective tax rates across US companies. This table, for instance, I've broken down industries in the US into 5 groupings based on lowest to highest effective tax rates. Now, of course, there's too much to get in this table, but if you look at the industries which have the lowest tax rates, you see a large percentage of them are technology pharmaceutical companies. And if you look at the companies that pay the highest effective tax rates, a lot of retail in there. And we talked earlier about how some companies have the capacity to defer taxes more than others. You see that show up in the effective tax rate. So if I were to read the tea leaves here, it looks like, the real estate companies, obviously, or REITs in particular, pay very little in taxes simply because their structures are pass-through entities. But technology and pharmaceutical companies pay among the lower taxes among US companies. And retail companies pay higher tax rates. Now, I started thinking about what do technology and pharmaceutical companies share in common, and they do invest in the form of R&D. Their CapEx is a form of R&D. You're saying, so what? Well, it's one form of CapEx where you get immediate expensing, which is a huge tax benefit. And it also gives them more discretion in how much they report in taxable income, because you can just move your R&D to this year if you want to have less in taxable income. So I did break companies down based on R&D, and there's a mixed story in what I've found. If you break down companies that have R&D into 5 groups based on how much R&D from lowest to highest, there seems to be a very clear pattern. Companies with more R&D expenses as a percent of revenues, far fewer of them. So if you look at the top quintile, far smaller percentage of them report taxable income. They pay lower effective and cash. In fact, they pay almost no taxes. Now, before you get too excited, though, and say this is the source of the problem, this is why effective tax rates vary. If you look across all companies with R&D and compare them to companies without R&D, it becomes a lot murkier. In fact, a higher percent of companies with R&D report taxable income than companies without R&D. It is true that companies with R&D have lower effective tax rates, but they pay more in cash taxes. What's the bottom line? I think the R&D is a stand-in for tax deferral, but more for young growth companies and for more mature companies. Now, I've also heard the story floating around that it's big companies that are not paying their fair share, usually backed up with anecdotal evidence. Look at FedEx, look at Amazon, look at GE. And I've always been skeptical of anecdotal evidence because you have a story, I'll have a counter story. So what I did was I broke down companies based on market cap from smallest to largest deciles. And the pattern here is very clear. Larger companies pay much higher effective taxes than smaller companies. So it's true, there might be anecdotal evidence you can point to that shows some large companies don't pay their fair share. And that's perfectly okay. But don't make a blanket statement that large companies are not paying their fair share. So I'm going to close with some advice, not that anybody's asked me for this advice. If I were asked for advice on what to do about the corporate tax code, I have 5 suggestions. First is get your mission right. Make up your mind, is the tax code an instrument for collecting revenues for the government, or is it an instrument to mete out punishment to bad companies and reward good companies? Remember, most of the deductions and credits you see in the US tax code reflect the desire to use it as a punitive instrument or as a rewarding instrument. Second, remember, all tax talk is agenda-driven, including anything I might say. Economists, experts, the CBO all bring agendas to the table, and they will use data to back it up. But the data here is very easily malleable. It's easy to lie with numbers, especially with taxes. Third, if I were to summarize what I see when I look at the US versus the rest of the world, the problem here is not that the marginal tax rate in the US is too low at 25%. It's well within the bounds of what you see in the rest of the world. It's that the tax deductions and credits are far greater in the US tax code than in other tax codes. If I had my druthers, I'd focus on removing those tax deductions and credits. I know easier said than done than raising the tax rate. And the reason I think that will be more effective and fair is right now raising the tax rates will punish the companies that you saw pay the highest effective tax rates even more. Those retail companies already down on their knees, you will hurt even more. Those technology and pharmaceutical companies that are already helped by the tax code will look even better on a relative basis. Fourth, whatever you do with the US tax code, remember you don't operate in a vacuum. You're part of a global economy, and companies can move not just their income, but their incorporation from country to country. I know there's talk of a global tax rate. It's easier said than done. But for the moment, you cannot unilaterally change tax code and make yourself an outlier. There is no going back to pre-2017 numbers. Finally, I think we need to provide long-term stability. Whatever's done to the tax code, do it and just leave it alone. I mean, already we're trying to revisit a tax code change 3 years after the last major change. This is no way to manage tax codes. How do businesses make long-term decisions when you keep changing the rules in the tax code on them? I have zero expectation that any of these suggestions will be taken to heart, but I'm looking forward to see how this debate plays out. How many numbers get used in bad ways to justify whatever people are going to say? But I look forward to seeing the debate nevertheless. Thank you very much for listening, and I hope you have a good day.